folks, hope you all are doing well. I am Karan Bandal from Econosite, and in this video, let's take a look at why India is bucking the trend of a global slowdown. To begin, why are experts saying that the global economy is slowing? According to the IMF, global growth is projected to fall from an estimated 3.5% in 2022 to 3% in both 23 and 24, while the Conference Board has an even lower projection for the current year and the next. The growth engine of the world, China, has been bogged down by a multitude of domestic issues, which is reflected in the fact that the World Bank has cut its 2024 GDP growth projection for China by 400 basis points. That means for almost a $20 trillion economy, this cut translates to an evaporation of a massive $80 billion worth of economic activity. Same is the case for the 27 country bloc, the EU. Its growth projection is also cut for this year as well as the next. United States stands out, however, where the growth forecast is not cut, but the country is expected to slow down to a growth rate of just 1% in 2024. In the midst of this slowing trend globally, India will keep the title of the fastest growing major economy this year with a projected growth rate of around 6.5%. On top of that, India is forecasted to remain on a relatively healthy growth path in the medium term also. Why is that? Well, let's see. First, growth is firming, not stalling. See, the GDP growth rate is only getting stronger since the quarter that ended in December 22. India's growth momentum is in stark contrast to the rest of the Asia-Pacific region where growth is generally slowing. The growth is mainly coming from domestic demand and is spearheaded by capital investment. You can see capital expenditure has been a constant contributor to the growth in every quarter, and as we discussed several times in the past, this year India has made an all-time high allocation of $122 billion for infrastructure. This bodes well for India's future growth as this focus on asset creation is likely to raise the country's non-inflationary growth potential. To expand on the domestic demand story, household consumption is holding up well, helped by improvements in the labor market. You can see the labor force participation rate is on an upswing and the unemployment rate is inching down. More jobs equal more people with money in their pockets, which translates to a growing consumption. Even though we see improvement in the labor market, we need to realize 38% labor participation and a 7% unemployment is far from the desired levels. At a minimum, India needs to target labor force participation rate above 60% and unemployment rate below 5%. Second, budget deficit still supports growth. The fact that India runs a budget deficit means that the Indian government spends more money than what it brings in terms of taxes and other receipts. India's budget deficit skyrocketed to 9.2% of the GDP as it stepped in to support the collapsing growth due to COVID lockdowns. On a positive note, this budget deficit has been falling sharply, yet remains elevated with the government targeting a further 50 basis points reduction for the current financial year. So far this year, India is on track to achieve the fiscal deficit target, which means India's cumulative deficit by March 2024 will be around $200 billion. And since a significant part of this spending is directed towards capital expenditure, India's long-term growth potential will be well served. Third, a stable currency. One of the surprises of the year has been the resilience of the Indian rupee. Since October 2022, the rupee has maintained a very tight band against the US dollar. This outperformance is such that the rupee is the third best performing currency in the Asia-Pacific region year to date. The currency has been holding its value when even the Chinese yuan and the Japanese yen have weakened substantially. A 100 basis points positive spread for the rupee does provide the needed support to the currency. In other words, India's benchmark interest rate being a full percentage point higher than the US benchmark rate discourages the outflow of the capital from rupee to the US dollar, whereas capital outflow towards the US dollar is encouraged where the spread is negative. A relatively strong currency is complemented by India's stable foreign exchange reserves or import cover. Sitting at roughly $600 billion, India's import cover is holding up well above the 6-month mark, usually reckoned to be a minimum requirement for emerging market economies, and has been rising recently. A relative strength of a currency helps attract and retain foreign investment in the country, which in turn supports growth. And fourth, India's inflation. Earlier this year, India's inflation came down within the central bank's inflation target of 2 to 6%. But erratic monsoons have hit agriculture, pushing up seasonal food prices sharply, and that has lifted inflation back above the central bank's target. Though it is coming down again, and the expectation is that inflation will keep moving lower over the second half of the year, approaching close to 4% with the release of October 2023 data. Predictable, stable, and a subdued level of inflation encourages the long-term private investment in the economy, in turn supporting the economic growth. Finally, a bonus development in the future to look out for is the inclusion of government bonds into global indices. JP Morgan recently announced that it will include Indian government bonds in its emerging market bond index next year. What this essentially means is that foreign passive investment will now automatically flow into Indian assets. Estimates vary, but substantial inflows of foreign capital of between $25 and $40 billion are thought likely to be attracted to Indian government bonds as a result. The benefit? It will support the currency, help lower the interest on government bonds, and lower the borrowing costs for Indian companies through lower rates on corporate bonds. In summary, India does stand out in a slowing global economy. Surely, there are macroeconomic factors that supports India's growth exception that we discussed. In addition to that, there appears to be a presence of a subjective optimism among Indians, which also may be supporting consumer sentiment. What remains to be seen, how long can India maintain this outsized growth momentum? I hope you found this analysis interesting. I'll speak with you again next week. Until then, take care.